Okay, good afternoon and welcome back to our options education webinar series. Today we're going to be talking about a beginner topic. We're talking options 101. We're going to talk about how to profit from bullish, bearish, and neutral markets from a beginner's perspective. And the reason we're doing this is because options trading is something that takes time to learn. It's not something you master in a day. That's part of why we are here to do options education every single week. We're dedicated to helping you better understand all the different versions of options trading that you can utilize in a portfolio and really help you provide the tools that you need to actually implement them. So today what we're going to do is we're going to go through the basic strategies for those of you that are starting out with options trading. I want to make sure everyone understands the best practices for starting points and understanding the common mistakes that most beginners make to hopefully help you avoid some of them. But today what I'm going to do is I'm going to really break down the basic concepts of buying calls and puts and the difference between trading options versus trading stocks. Hopefully, for those of you that are brand new, I will not only show you this from a conceptual perspective, but actually show you real examples so that you understand what we're talking about with the tools that are available to you here at First Trade, now at Options Play. Now, this webinar is geared towards beginners. However, if you're already trading options, I really hope that I show you some of these basic concepts in a different light so that hopefully you can start thinking about options in a different way and open the possibility of options. Because I'm going to break it down into a way where you can think of options from a basic arithmetic perspective. And if you really understand it from that basic perspective, all option strategies is really building on top of that foundation. So today we really want to build that foundation, a solid foundation, so everyone understands the benefits of just basic calls and puts. And once you understand that foundation, you can really start leveraging that into more complex trades and really giving you options, if you will, for a lack of better terms. So let's go ahead and get started. My name is Tony Zhang. I'm the Chief Strategist here at Options Play. The webinar today is structured in a way where I have about 15 minutes of slides, but what I'm actually going to do is I'm going to actually cut in between the slides back to Options Play to show you some real examples as we go along, and I'll go flip a little back and forth between the slides and Options Play. And I want to provide real concrete examples of all the things that we're going to show you here today. This webinar is recorded, and the slides will be available to you when we send out the recording about half an hour after we finish here today. So don't worry about keeping up. If there's something that you don't understand and you want to find out more about, you can always watch the recording, and you'll have the slides to follow with as you go along. So just a bit of housekeeping before we go ahead and get started. If you don't have access to Options Play, the tool that we're going to be showing you here today, you can sign up for a free 30-day trial at optionsplay.com. Membership runs $50 a month or $500 a year for the platform, and this will give you weekly options educational webinars like the one that you're on right now, daily trade ideas that are emailed to you in your inbox every morning. And for those of you that are brand new, I highly recommend you to take a look at the Options Industry Council. The links for this will be included for you in the slides that I'll send out after we finish. So let's go ahead and get started. Now, first, what I want to make sure everyone understands is really the difference between trading stocks and options, because a lot of times we really are comparing buying a stock versus buying a call or any of the other strategies that you might trade. So I really want to dive into what is the fundamental difference between trading stocks and options, because once you understand that, you will have a better understanding as to when you should be trading stocks and when you should be trading options. Once you have that basic understanding, then I want to talk about the three basic strategies: calls and puts and selling cover calls. And I'm covering these three strategies because this is the three most popular trading strategies amongst beginners. And these are the three strategies that you have the ability to trade as a beginner, because you have to apply for an options agreement and you're not always approved for trading the more complex strategies. So we're going to talk about the basic strategies that everyone is approved for when you first apply for an options account. Once you truly understand these strategies, and again, what I really want to do is break down these strategies to a very fundamental level so that you have a better understanding of them, and that is going to allow you to build up and trade more advanced strategies down the line. But in order to truly understand the difference between trading stocks and options, we do have to understand the Greeks. It's not a fun topic per se, but it is really important to understand, at least from a theoretical perspective, you don't actually have to memorize the math. You don't have to be scared about the Greeks, even though sometimes it can be scary, because options play actually does the work for you, and it will actually calculate what you're really looking for by understanding the Greeks. So you just have to understand it from a fundamental perspective. And lastly, what I want to cover is common mistakes. What are some of the mistakes that users typically make with these three basic strategies, so that hopefully help you avoid making those same mistakes? And like I said, throughout this whole process today, I'm going to be showing you strategies using options play as I flip back and forth between the slides and the tool. Now, before I actually go ahead and get started, I want to launch a quick poll and get a sense for the audience here. How many of you have traded options before, and how many of you are just learning? Okay, so a very clear indication that almost 95% of you have traded options, 6% of you are just learning. So for those of you that are learning, welcome. I hope everyone here on this webinar is open to helping others learn as well, because that's really what we're here for. We're here to provide a community that you guys can all utilize to learn more about these strategies and have the tools to actually implement what you've learned. So those are some of the things that I really want to show you guys, for those of you that are learning, and for the 94% of you that have traded options before. I really hope that this provides a new understanding of options from a more fundamental level, because if you do understand it from a fundamental level, that's really going to help you grow as you go along. So let's first break down trading stocks versus trading options. So stock trading is what I consider simple but limited, meaning it's really simple to understand, it's really simple to grasp and execute, but you have very limited scope in terms of what you can do, because stock trading only gives you exposure. The only exposure you get with stock trading is direction. That's all you get. And you effectively have two choices. You have two choices in direction. You can go either long the stock or short the stock. If you're bullish, you can buy the stock. If you're bearish, you can short the stock. Even in those cases, shorting the stock is not always a viable opportunity for every single stock. It's only available to you as an option for certain stocks. Versus options trading, on the other hand, is more complex, but gives you far more flexibility in terms of what it is that you want to do, because options give you exposure not just to direction, but also to magnitude and timing. So this is really the key difference between trading stocks and options. When you're trading stocks, you're really only concerned about direction. When you're trading options, you're concerned about direction, magnitude, and timing. So what I mean by direction is whether you think an asset price or a stock price will go up or down. Magnitude means how far do you think it will go up or down by? Do you think it'll go up by 1% or 10% or 100%? And lastly, timing. How long do you think that will take? So if you think a stock is going to move up by 10%, do you think that will happen in the next month, 3 months, or a year? So those are three things that you have to be concerned about or be aware of when you're trading options that you don't necessarily have to think about when you're trading stocks. In stocks, you just have to worry about direction. Now, when it comes to direction, you get to choose whether you want to buy or sell, and you get to choose whether you want to buy or sell a call or a put. And this is sometimes confusing for users, because to have two different things that you have to worry about. So this is one of the things that I want to break down from a fundamental level to have you better understand these four possibilities. And when it comes to magnitude, this is really where you have to go about selecting a strike price. This is where, again, sometimes there's a little bit of confusion as to what is the appropriate strike price. So those are some of the things we're going to go through today. It's what we actually do on every single webinar, is we talk about what are the appropriate strike prices for pretty much every type of strategy that we explore. But it's really important to understand from a fundamental level what the Greeks tell us in terms of helping us determine our strike price. And lastly, timing, meaning choosing the correct expiration date. So those are something that we'll also talk about for these three basic strategies, is how to pick expiration dates that are suitable for each strategy. And the answer is that it depends on each strategy. So really, we want to make sure we understand the best practices of each one. So that is the fundamental difference between trading stocks and options. Stocks is simple, but you have limited scope as to what you can do. Options trading is more complex, but you have a lot more flexibility in terms of being able to profit from different types of outlooks. So let's break down the basic strategies. There's basically two primary use cases of options that span multiple strategies, but within the strategy that we're going to talk about here today, the two main use cases that you have, number one is to generate income. This is by far the most popular use case of options, is to utilize selling options to generate income. The other main use case is to simply speculate, meaning you have a bullish, bearish, or even neutral view on a stock or ETF, and you want to be able to leverage that view and be able to profit from that view. So between these two strategies, generating income, the strategy that you would do is you would sell covered calls. I would imagine that since 94% of you have said that you traded options before, you're probably familiar with what a covered call is. A covered call is where you sell a call option against any stock in your portfolio. This requires at least 100 shares of that stock. And a good starting point for this, and we'll actually dive into these strategies itself, is that you generally want to sell about a 1 month out of the money calls as a starting point when you're selling covered calls. And if you don't know what that means, we're going to come back and explore that in a minute. On the other hand, for those of you that have a bullish, bearish, or even neutral view on a stock, this is really where you're trying to speculate. You want to express a directional view and be able to profit from that if you are correct. And there's two primary use cases here. So if you're bullish on a stock and you want to be able to take that bullish view, buying calls is a great way to go about doing that because it gives you directional bullish exposure, but you have limited risk. And the key here is to have that directional exposure, but have limited risk. On the flip side, this is really where options start to expand your options, because when you have a bearish view on a stock, shorting that stock is not always an option, nor is it necessarily recommended, because when you short a stock, you truly have unlimited risk. And this is really where options shine, because you can buy a put option on that stock, and that will give you a bearish exposure to that stock, but you still have limited risk. And that's really one of the key benefits of trading options or buying options, is that when you buy an option, no matter what happens, the most you can lose is what you've paid for that option. So you effectively put in a floor as to how much money you can lose. And that's a key aspect in managing risk that you get with options that you do not get when you're trading just stocks. And when you're buying calls and puts, a good starting point is to buy about a 1 to 2 months out in terms of expiration date, and starting out with what we consider in the money strikes. So strikes that have a bit of intrinsic value to them as a starting point. So let's actually break down these strategies and start exploring them. So we're going to start off by talking about stock trading, just to help frame your mind as to what stock trading looks like, and then we're going to flip over to options trading, and hopefully that will help shape your views as to how options trading works. So when you're with stock trading, you effectively have two options. You can buy the stock when you're bullish on the stock, or you can sell short a stock if you're bearish on the stock. So those are your only two options. I have a very clean chart. This is Apple trading at around 188, 189, and you have two possibilities. You either believe that the Apple stock is going to rise in value in the future, or you believe it will fall in value, and those are your two options. And with either two options, you get immediate gains if the directional view that you have is correct. So if you're bullish on Apple and you buy Apple stock, even if it goes up by a penny, you will have incremental gains for every penny the stock goes up by. And this is really where you have symmetrical exposure. So for every dollar Apple goes up, you make $1. For every dollar Apple goes down, you lose $1. And this is really the key to stock trading, is that symmetrical exposure. You get exposure on both sides, and you can do this for any time horizon. So it doesn't matter whether you're bullish on Apple over the next minute, the next day, the next month, the next year. You can buy Apple. It's the same strategy. You just simply buy Apple and hang on to it for as long as you want. And the limitation of this is that there's no neutral options. Meaning, if you have a neutral view on Apple, meaning you think it's going to mostly move sideways, you're not bullish, you're not bearish, there's really nothing you can do. The only thing you can do is move on to the next stock and try to find an opportunity on a stock that you actually think will rise or fall in value. So that's just what stock trading looks like. It's fairly simple to understand, or easy to understand, and relatively easy to manage. So on the flip side, with options, you have lots of options. Unlike stock, where you effectively either are bullish or bearish, and those are your only two options, with options, you have a lot of different options. So what I want to do is help to demystify all of these options with some basic multiplication to hopefully simplify the different views that you can have with options. So, like I said, with options, you have four choices. You can either buy or sell the option, and you can either buy or sell a call or a put option. So those are your different choices. So what I put here is effectively plus or minuses on each one. So buy being a plus, sell being a minus, and call being a plus, and put being a minus. So I think that is fairly intuitive for most people to think about: buying being a plus, call being a plus, and sell being a minus, and puts being a minus. So let's look at basic multiplication to help us better understand these strategies. So first one I have the possibility is to buy a call. So when you buy a call, you have a positive and a positive, which if you multiply together, it gives you another positive. So in this particular case, buying a call is positive or bullish. On the other hand, if you're selling that call, which is a negative, and multiplied by the positive call, what you get is a negative, because negative multiplied by positive is negative. So selling a call here is a bearish trade. Next, buying a put. You have a positive, buying positive buy, and you have a put that's a negative. Negative times positive is another negative, so buying a put is bearish. And then lastly, you have selling a put. This is where we have a negative, a double negative. A negative multiplied by a negative gives you a positive number. So in this particular case, a sell put is a bullish strategy. So this is how you can back out, and always remember, regardless of whether you're buying or selling, whether you're buying or selling a call or a put, you will always have an easy and quick way to remember whether the strategy is a bullish or bearish trade. Now, this is really going to help frame when you start trading complex options and you're buying and selling multiple calls and puts, what you're actually doing. So you can always think of that, and I can come back to this as we start exploring more advanced strategies as to how you can use this to build more advanced strategies and understand how complex strategies like verticals, even butterflies and condors work, because you're effectively just combining bullish and bearish combinations with each other together to form these complex trades. So with that, what I'm going to do is I'm going to now take a look at that same example of Apple, but now instead of buying a stock, we're going to buy a call. So buying a call, again, is a bullish strategy. So if I'm bullish on Apple, buying a call is a strategy that I can utilize. Now, the difference between buying a stock and buying a call is that when you buy a call, you only have gains if both the direction and magnitude move is higher than the premium that you've paid for the call. So this is where you have asymmetrical exposure. This strategy gives you unlimited gains if you call the direction correct. But if, let's say, you're wrong on the directional trade, if let's say you think it's going to go up, but the stock ends up going down, you actually have limited risk. So as you can see here, if the stock goes higher, I have continuously make more and more money as the stock goes higher. But no matter what happens, at some point, I will have I have maximum loss that I won't go any further. So no matter how much the stock goes lower, I only have a certain amount of risk, and that risk is based on how much I pay for that option. And lastly, when you buy a call, you actually have exposure only until expiration. So as you can see, I have an arrow here, but it ends at a certain point because that is the expiration date, and I only maintain exposure up to that date. So if you look at this stock, if you look at this chart, as you can see, Apple's around 188 right now. What I have here is that, roughly I have a 192 break-even price on this call option. What that means is that the stock needs to rise to at least 192 or higher by the expiration date in order for this strategy to be profitable. Unlike the stock, as long as it moves by a penny higher, it will be profitable. So you have to think about not only what directional view do you have, but also, is it going to overcome the premium that you've paid on that call option? And that's really an important thing to understand. So for that, what I'm going to do is I'm going to jump over to options play. I want to show you some real examples to help bring this concept home. So Apple's trading at around 188.58, 188.5 right now. What I'm looking at here is I'm going to look out to May, and I'm going to look at a 185 call. So a call with a strike price of 185. That's currently trading at $9.60. So what I have to do is I have to look at the break-even price of this stock as actually the strike price plus the $9.60 for this option. So that means my break-even price on the stock is $194.60. So not only do I have to be bullish on Apple in order for me to consider buying this call, I have to be bullish enough to think that it's going to go above 194.60 by May 17th in the next 50 days. So I have to look at my chart and say, where's 194.50? It's roughly where it was 3 days ago, right where my mouse is right now. So the stock needs to move a little bit higher and more in order for this strategy to be profitable. So you have to ask yourself before you buy a call, not only do I think will the stock rise in value, but I also have to ask myself, do I think it'll rise in value enough more or beyond that break-even price, which is 194.60, and that's 185, the strike price, plus the $9.60 that I'm paying for this call option, and that tells me my break-even price. Now, keep in mind that that's your break-even price at expiration. So you can potentially make money on this trade if it doesn't have to reach that price by expiration. If it reaches that price, let's say 195, prior to expiration, you can still make money. Just maybe not as much money, but you can still make money. So if the stock reaches 195 on April 22nd, then I'll still make a 23% return. And this is really where the options play tool is designed to help you better understand each strategy, not only at expiration, but also what happens if the stock hits that particular price upon expiration. So as you can see, the stock needs to be at 194.60 at expiration for this strategy to break even. But we don't trade options to break even, right? We trade options because we want to make a profit. So this stock needs to move beyond 194 in order for this strategy to be profitable. So if the stock reaches, let's say 200 by expiration, now I have a $540 profit or a 56% return. So this is really the question that you have to ask yourself when you're trading options is not only do I think it's going to go higher, but do I think it's going to go higher by a certain amount before a certain date? These are the differences between trading stocks versus trading options that you have to think about before you get into a trade. I see too many beginners start out by, they learn that call options are bullish. So when they're bullish on a stock, they just go out and buy a call option and hope for the best. That's not a really good strategy. You should not only hope for the best, you should know exactly how far the stock needs to move by which date in order to be profitable. And then from there, ask yourself, do I think the stock's going to make that kind of move within that amount of time? If you do, then a call option is suitable for you. If you don't, then perhaps you're better off trading the stock. So that's what I'm hoping to illustrate here by using these types of examples. So now let's go back to the PowerPoint slide. Now I want to take a look at what happens if we have a bearish view on Apple. Same position, Apple's trading at around 188.95, but now you have a bearish view. You think for whatever reason that the recent announcements with the product launches on Apple TV and the news is not going to quite cut it for them. They've had the significant rally. It's probably going to peter out, and you think, and you're bearish. So what can you do? You can buy a put option. This is really where you have a lot of options when it comes to trading stocks versus trading stocks. And this will give you gains, again, only if the direction and magnitude move is lower than the premium that you've paid. So basically the opposite of what you were doing before, just now you have to have a big enough move to the downside in order for it to be profitable. Same thing, you have asymmetrical exposure, which means that you get downside exposure all the way down to zero. But if Apple rallies up to 200 or 210 or 220, you have limited risk, so that you never risk more than what you've paid for that put option. And just like the call option, you maintain exposure only until expiration. So let's take a look at a view on Apple now. So now instead of selecting I'm bullish and looking at 3 bullish strategies, I'm now going to select I'm bearish, and I'm going to take a look at 3 bearish strategies on Apple. So same here. What I'm going to do is I'm going to move this over to the May expiration. I'm going to looking at a 190 put, and that cost me $8.05. So what's my break-even price on this stock? So because it's trading at the strike price is 190 minus the $8.05 that I've paid for this put option makes my break-even price 181.95. So where's 181.95? It's about right here. So if I'm bearish on this trade, not only do I have to be bearish, I have to be bearish enough to think that it's going to go below 181.95. And that's by expiration date, which is all the way out here, roughly May 17th. So as you can see, when I'm looking at a chart, I can ask myself, do I think the stock's going to go below 181.50 by May 17th? Yes or no? If I do think it'll go below 181, like let's say down here, then it's a suitable strategy. If I think it's only going to be around 185 by May 17th, then maybe that's not the right strategy. So this is where our P&L simulator really comes into play, because again, if I think it's going to go to 181.50 by May expiration, 181.95, sorry. This is where this strategy will basically break even. But if I think it's going to move down a little bit further than that, then I will make a profit. If it doesn't move as far, then I'm going to lose the amount of money that I've paid for that call option or that put option. So this is really where you can utilize our tool to play around with different outlooks and see exactly what your expected return is if you're correct. And more importantly, what your expected gains or losses are if you're wrong. What happens if Apple rallies from here? What happens if it goes back up to 197 or 200? How much money do I lose? It's really important not only to plan for what are your potential rewards, I actually think it's more important to plan for what are your potential risks if it doesn't work out, and ask yourself, am I comfortable taking this type of risk? If you're not, then maybe you're better off trading the stock, or maybe not trading this trade at all. Only trade a strategy if you're comfortable with losing that amount if you are wrong. And that's really the key of successful trading, is being able to manage your risk. And buying call or put options really allow you to manage your risk, because no matter what, you're limited to risking $805. No matter how wrong you are on this trade, you're limited in risk. And if you're right, you can have potentially quite a bit of upside if you are right on that trade. And that's really what options really give you, is the option to really take any direction, any magnitude, and any time, and be able to express that in a trade that you can't do if you're just trading stocks. Lastly, what I want to talk about is more of a neutral view. So this is really where cover calls comes into play. And what you're effectively doing on a cover call is you're selling a call. So we talked about buying a call, buying a put. Now we're going to talk about selling a call. Now, selling a call is a little different, because in the other two examples, the stock needs to move a certain amount before it's profitable. When you're selling a call, it's the exact opposite. You're taking the other flip side of the coin. So now, as long as the stock doesn't move as much, you get to make a profit. So here, what I have is Apple stock's trading, again, around 188.95. And what I'm doing here is I'm selling, let's say, a 200 strike call against that. And what that means is that as long as the stock stays below $200, I get to make money. So here, as you can see, even if the stock rises up to $200 and stays below it, that's where I'm going to make my profits. But my profits will be limited. So no matter what happens, even if the stock goes all the way down to zero, I have limited gains. But if the stock really rises above 200, that's really where I start to lose money. Now, the reason that I'm not talking about the losses here is because we're talking about a cover call. We're not just selling a call naked. If you were selling a call naked, you would truly have unlimited risk to the upside. But that's not what we're doing here. We're collecting income by selling the stock only if we own that stock. Because if we own the stock, what that allows us to do is potentially sell the stock at the strike price. So if you own the stock at 188 and you sell a $200 call option against it, you collect income as long as the stock stays below 200. But if the stock does rally above 200, you effectively have sold your stock at $200. So you don't have any true losses above $200. You just simply are not participating in any gains above 200. And what this does is it limits the risk with a long stock position. So your stock position is really what hedges your risk against losing money on the upside. And you can rinse and repeat this for consistent income. So you can actually sell calls on your stock, and as long as the stock doesn't rise to $200 or more, you get to do it again in that following month. So if the stock rises a little and then falls back down to 179, you can sell another call and you can gain some more income. And you can keep doing that over and over again until the stock does rise above your strike price. And at that point, you effectively sell your stock at a profit. And this is something that if you want to learn more about, we do have separate webinars just on this one strategy alone, because almost 40 to 50% of options traders utilize this one strategy, even though out of the hundreds of strategies you can utilize, this one accounts for almost half of the trading volume in all of the markets that are traded. So that's why this is one strategy that we do cover a lot, and we have a whole webinar just on that if you want to learn more. So with that in mind, now let's go walk over to the Greeks. This is what tends to scare some people off when it comes to the math that's involved in this. And this is really how we calculate risk and reward. And because this is how we calculate risk and reward, and it's a little complicated, some people feel that options is too complicated or too risky because they don't really understand this. So this is why I want to make this as easy as possible. And I want to show you how you can avoid being scared by these types of math equations, because OptionsPlay does the calculations for you. So when we talk about delta, this is really what tells you how much money are you going to make or lose from this option if the stock goes up by 10% or down by 10%. And delta tells you how much money you make or lose on your option if the stock goes up or down. So delta is really the change in the option price with respect to change in the stock price. So if you have an option that has a delta of 0.5, that tells me that for every dollar that the stock moves up or down, the option price will fluctuate by half as much, 50 cents up or down. So delta tells you exactly if the stock was to rise by 10%, how much money you should expect to make on your call option, or how much money you should expect to lose on your put option. That's what delta is able to tell you. The second most important Greek is theta. This is the concept of, because an option has an expiration date, the price of that option will actually decay in value as you approach options expiration. So that decay works in your favor if you're selling options, and it works against you if you're buying options. And this is why, because of the fact that options decay in value, generally speaking, more traders will typically sell options than buy options. You're only buying options when you're trying to speculate. That's really the only time you're doing that. So theta tells you exactly how much the option price will decay as time goes on. So if you see an option with a theta of 0.05, that's telling you that the option price will lose 5 cents per day as it goes on. So just a quick overview, and this is one of the things that I wanted to show you, is we talk about delta, and sometimes we look at delta of an option, and if you want to look at the delta of a put option, you can use this in OptionsPlay. So this will tell you that, you see here, buying that 190 put is roughly a 50 delta put on Apple. But what does a 50 delta put actually mean? It means that for every dollar that Apple decreases, you will get a $50.33 in profits. But due to time decay, you lose about $7 per day as time erosion as expiration approaches. So if you want to learn more about the delta and theta of each option, you can do that here at the bottom of your screen in OptionsPlay. But what we really do is we really try to take that math away from you and say, well, in reality, you don't think in delta and theta terms. You think that Apple's at 188. I think it's going to go down to 175. And what we do is we calculate the delta for you and show you exactly what the return is that you're really looking for, because that's the whole point of calculating delta, is to figure out what is my potential profit, what is my potential risk. And the only reason that you look at theta is to say, well, how much is the price of my option going to erode if this takes 3 weeks to happen? So what we do is we actually calculate delta and theta for you using this price slider and using the time slider. So you just input how long you think the stock will go. We'll take, you put in the direction and you put in the magnitude, and we do the calculations for you. And for those of you that are a bit more sophisticated and you are asking about volatility and implied volatility and changes in implied volatility, you can even make further adjustments to your volatility assumptions. But the one thing I will say is, unless there's a major event coming up where there's going to be a pronounced change in volatility, and in reality, the only real true pronounced change in volatility that you can accurately predict is after earnings, volatility comes down. Otherwise, volatility is this factor that, generally speaking, I don't know about you, but I certainly don't have any way to forecast whether volatility is going to increase or decrease, because that's based on future news that I have no visibility into. But if you want to make those changes, you can make those changes in Vega here. I will say, for those of you that are advanced, notice how little the price of the option changes with pretty big swings in volatility. As you can see, when volatility is at 27%, I'm making $1,113. Even when the stock even when volatility increases by a substantial amount, that dollar amount changes by a small amount. So don't put too much focus into volatility, because volatility at the end of the day has a relatively small impact on your P&L, versus if the stock moves down a little bit versus a lot, as you can see, the swings in profits are huge. So from 175, you have $600 in profit. At 170, you have $1,200 in profit. So double the amount of profit in for that $5 move, which for Apple, as you can see, it'll make a $5 move in a matter of a couple of days. So you have far more exposure to delta than you have in theta and in Vega. So keep that in mind. I know a lot of you will look at implied volatility and study volatility and try to figure out what is the optimal strategy around volatility. But keep in mind, your exposure to volatility is relatively small. Your biggest exposure is direction, or delta. So make sure that you actually spend more time figuring out where you think the direction of the stock is going to go, and slightly less time on figuring out where volatility might go. So with that, what I want to do is just wrap this up by talking about what are some common mistakes. So number one, we talked about 3 different primary strategies, and for speculation, what you're really doing is you're buying options. And there tends to be a set of mistakes, or common mistakes, that people make when they're buying options. Number one is they hold onto a trade until expiration. You generally don't want to hold on to any options that you've bought until expiration, because of that time erosion we talked about. That time erosion is working against you, and it actually accelerates as you get closer and closer to expiration. So generally, don't hold options in the last couple of weeks if you're buying that option, because in those last couple of weeks, that time decay really accelerates and it starts to work against you, which means that the stock really needs to make some big moves to overcome that time decay. Second, what we see is using expirations that are too short. If you're going to buy options, go out at least 1 to 2 months out to buy options. You don't want to buy an option that expires in a couple of weeks. Again, because of that time decay, it's going to work against you very heavily. You can always buy a 2-month option, hold on to it for 2 weeks, and sell it. But if your time horizon on a trade is just a week or two, you should still buy a much longer dated option and simply just sell it 1 or 2 weeks later. On the flip side, if you're selling options, and this is not limited to just cover calls, meaning if you're selling puts, if you're selling other types of strategies, same thing. What we generally find is that people tend to sell calls that are too close to the current price, or sell puts that are too close to the current price. People do it because there's a higher amount of income when you're selling relatively calls that are close to the current price. However, based on our back testing, and we cover more about this during our cover call seminars, it really caps the gains that you have, the potential gains you have on your underlying stock. And that's not something you want to do in the long run, because that's going to underperform your portfolio. So you generally want to sell calls that are relatively far away from the current price. And we talk about that in our cover call webinar. So if you want to learn more, please take a look at that. And lastly, when you're selling calls, we tend to see that sometimes people use expirations that are too long. So just the exact opposite of buying options. When you're selling options, you want to sell short-dated options. You want to sell options less than 1 month from expiration, because again, you're going to be able to take advantage of that time decay. That's really what's going to allow you to have access to the best part of selling options, which is that time decay, and that accelerates as you get closer and closer to expiration. So that's really what you want to be able to take advantage of when you're selling options. So with that, I'll jump over to options play real quick. Again, I want to show you quickly, just in a few minutes, how you can utilize options play to quickly find bullish and bearish strategies, just like I did with Apple. How to use the P&L simulator, again, to utilize figuring out how far the stock needs to move in order for you to be profitable and looking at the break-even analysis. Then what I'll do is I'll flip over to the cover call ideas and show you the income panel to show you how you can quickly find cover call ideas. And lastly, take a look at the strategy checklist for beginners. So with that, what I'm going to do is I'm going to, if anyone has any symbols you want to look at, please type them into the chat window. I will pull up any symbol and take a look at any large cap name that I can, that most people are familiar with. I'm open to taking a look at as an example. Larry is saying Microsoft. Okay, let's take a look at Microsoft. Trading at 116.93. So again, you have two options. You can select either I'm bullish and look at 3 bullish strategies, or you can select I'm bearish and select 3 bearish strategies. So, Microsoft, being that it's a very strong stock, technical score of 8, 1 month and 6 month trends are bullish. Something that we cover on a different webinar is looking at these indicators to get a sense for direction. And it's trading just above a support level, 115 support level. These are all, in my opinion, somewhat at least bullish things to look at. So I'm going to select I'm bullish, and I'm just going to take a look at maybe a May. I'm going to use May expirations just for clean expirations, clean monthly expirations. And we're looking at the May 17th 115 call. So this is trading at 530. That means that 115 plus $5.30 is 120.30. So $120.30 is your break-even price, which is right around the 52-week high. The 52-week high is 120.82. So what I would be basically asking myself is, do I think Microsoft will make a run at the 52-week high and exceed it by the May expiration, which is about here? So as you can see here, I'm going to pull out a little bit on my chart. Do I think the stock's going to make a new crack at the 52-week high by May 17th, which is right around here? From my perspective, if the stock is to bounce off this support level and make a new high, I would certainly imagine that it would make it before May 17th. It has earnings on May 1st, which is another catalyst that could potentially propel it above that 52-week high. So that would certainly be in the realm of possibilities for me. And I can use my P&L simulator to say, well, let's say this thing breaks up. This last move was from 116 to 120 or so, so maybe about a $5 move. So maybe I think it'll go to about 126 or so. As you can see, if the stock does move up to 126 by May 17th, I'm looking at a $570 profit, which is a 107% return. So those are the types of returns that I can expect. And good thing is that Microsoft's trading just at a support level, which means that if it breaks down even to about 113, I would consider myself not as bullish on the stock anymore. So if the stock does make it down to, let's say, 113, halfway between now and expiration date, I would lose about $344. So I can make about 570 if I'm right. I'll lose about 344 if I'm wrong. Those are the types of odds that I typically like, making about close to 2 to 1 on a call option if I'm right, and if I'm wrong, I lose about a little over half, 65% of what I've paid for. So this is how you can utilize options play to, number one, pick a symbol that you want to look at, very quickly pick a bullish or bearish idea, and be able to instantly analyze what are your potential outcomes. I'll look at one more example here. I'll use Lululemon. Lululemon is I think a stock that everyone's looked at. This stock really popped today because of earnings. Well, actually, let's not look at Lululemon because it popped on earnings. Let's look at Verizon. Verizon's at $59 and $8. This stock's really made a really big run recently. This stock really went from the December lows of 52 all the way up to $60. So it's made almost a 20% run since the December lows. So for me, there's, even though this is one of the strongest stocks in the market, well, it is very, very strong. It is literally one of the strongest stocks in the market. 1 month and 6 month trends are extremely bullish. This is a very large cap stock. These are the types of stocks that may not have as much room to run, but let's take a look at it. Let's say a 57.5 call is only trading at $2.36. So look, the break-even price of this is only $59.86. So these call options are extremely cheap. That's why the options play score are very, very high. So here, as you can see on a May option all the way out to May, this stock only has to move to $59.86 in order for this strategy to be profitable. That's, in my opinion, if you're bullish on this stock, very, very possible. But this also maybe tells you that, but I also don't think that there's necessarily a lot of upside on this stock. Maybe it'll maybe it'll go to 61. So as you can see, if the stock goes to 61, I only make $114 profit. And I do think that there's a fair amount of risk this will pull back to 59. So if it does pull back to $59, even halfway through, I only lose 15%. So not too bad if it does pull back to $59 or even lower. So this is really where, it depends. I just don't think there's a lot of upside here. So you have to ask yourself, do you really think Verizon is going to continue breaking above that 52-week high at 61.58? If you do think it's going to make a new high to 63, 64, you do have a lot of potential gains to the upside. So that's how you can utilize this tool very, very quickly to set up any call or put. And maybe I'll look at one bearish one if I have time. Let me see if I can find a more bearish one. Facebook, Amazon, Boeing, these are all fairly bullish ones. Let me see if I can find a bearish one. Roku, still fairly bullish. Maybe XLF. Here we go. This is a sector that's relatively beaten down over the last few weeks. Treasury yields have rallied. Financial stocks don't typically do well in this environment and in an interest rate environment that's not rising. So we've certainly gotten a bit of pressure, and this recently broke below that $25 support level. I think there's a lot of potential downside. So this could easily go down to $24, $23 to the downside. So again, let's look at a May. Let's say we look at a $26 put is fine. Notice how cheap it is. It's only 80 cents, which means that the break-even price on this is only $25.20. Extremely cheap because the stock only has to move down to, about $25.20 right here by May 17th. As you can see, that's basically flat on the stock. So if the stock moves any lower than that, you can be profitable on this trade. So very interesting trade in my opinion. So even if I think that it's going to go down to $24 by May, which I think is a fairly conservative target if things really head south for financials, if it moves down to $24 by expiration, 150% return. And even if the stock rallies to $26, $27, 26.5, halfway between now and expiration, I lose $53 to potentially make $120. So I'm comfortable taking a $53 risk to try to make $120 if financials do continue to move to the downside. And that's really the type of risk profiles that you're able to get by looking at options. And lastly, if you're looking to generate income, you can click on the income tab, type in any stock. Let's go back to Apple real quick. Apple's trading at 188.72. If this is telling me to look at the April 18th 197.5 cover call. So as long as Apple stays below 197.5, I'm able to take advantage of a 9% yield on this cover call. There's an 80% chance that the stock will stay below 197.5. This is how I can quickly find potential strategies to generate income. And one of the things we said that the XLF, the options were very cheap. What that means is that there's not a lot of premium in them. So as you can see on XLF, I'm not able to actually find a good cover call because even if I sold these cover calls, I'm not going to get a lot of yield, which works against you if you're selling cover calls, but works in your favor if you're buying these calls. Same thing with Verizon. I think we saw very low yields on Verizon. So I'd expect that similar type of thing. As you can see on Verizon, really not a lot of yield, only $23 in income on 100 shares of stock. So for almost $6,000 worth of risk, I'm only collecting $23. Not a lot of return for this. So this is really how you can utilize this tool to very quickly find not only opportunities to buy options for speculation, but also very quickly find options to sell options for income. So with that, I've already gone over by 5 minutes. I want to open this up for Q&A for all of you that participated. Thank you so much for taking the time out this afternoon. I will try to answer as many questions as I have time for, so please type them into your chat window, and I will try to answer as many questions as I have time for. So thank you so much for taking the time out this afternoon. So Andrew's asking, what do you feel is the most important technical analysis indicator for selecting a time? So the most important technical indicator is price. I get this question a lot. What indicators do I use? RSI, MACD, Bollinger Bands, all of these. Those are all things that will help support your views. But the first thing you should look at is price. Price is the most important indicator. Price is the only indicator that's truly what you would consider a leading indicator. All other indicators are effectively lagging the price. And they can be used to help confirm your convictions on the price. But by far, the most important indicator is price. So if you're going to learn about technical analysis, learn about how to read price action. That is the most important indicator. Can you show a Verizon cover call option? I just did that, so hopefully you were able to take a look at that. I have a question here from James. If volatility increases, how does your long call or put increase as well? So I just showed you that before on the P&L simulator, how to utilize the volatility slider. That will show you how your call or put will increase or decrease. Like I said, that volatility slider, not very sensitive. You can move vol by a lot and the price of your call or put won't be affected too much, but you can always use the volatility slider for that. Is there a stat on options play that shows what the probability of stock hitting a particular price? So that's what the probability of expiring worthless indicator on the income panel does. So when you choose an expiration date and a strike price, it'll tell you the probability of expiring worthless, and you can use the inverse of that to tell you what the probability of hitting that price is. Let's see. Here's a question about, will I get buy-sell alerts on my email or cell phone with your service? So we send an email every single morning at 6 a.m., so you get an email. If you're interested in cell phone-based service alerts, we do have a trading signal service using credit spreads if you trade credit spreads on StockTwits. If you want to learn more, you can send me an email at info@optionsplay.com. I'll enter that email into the chat window. If you want to learn more about our credit spread trading system that sends intraday alerts, you can send me an email and I'm happy to tell you more about that. Is there any performance numbers of the daily play trades? Yes, so we actually calculate the performance. You can find those we actually send you a link to that at the bottom of every single daily play. So if you find any daily play email, if you scroll to the bottom, there's a link for getting to the performance numbers. When are the Greeks calculated? They're calculated in real time. So every single time that the price of the option changes, the Greek calculations change as well. So they're calculated as we pull those prices. Are there any other questions regarding anything that we went over here today? If there are no more questions, I just want to thank everyone for taking the time out this afternoon. This was a webinar that was geared more so for the beginners. So I hope those of you that are, even though most of you answered that you have traded options before, I hope that you guys found this useful in helping you understand more from a fundamental perspective how to view options and think about calls and puts and think about break-even prices, which is something that I don't think everyone thinks about all the time, but it's really important to understand break-even prices to figure out exactly whether you should be buying calls or puts, selling calls or puts, or whether you should just be buying the stock instead of buying an option. So just because options exist doesn't mean that you should always trade them. So it's really important to understand when you should utilize them in becoming a better trader. And using the tools that are available to you here at Options Trade really allow you to better understand these strategies and analyze them correctly so that you know the true risk or reward of each strategy before you get into a trade, not after. So with that, I want to thank everyone for taking the time out this afternoon. We will send out the recording to everyone in about 30 minutes, so look out for that. You will have both the video as well as the slides in your inbox in about 30 minutes. Thank you, Richard. Thank you, Raymond. Thank you so much for participating and coming every single week. Really looking forward to kicking off April next week. Next week is going to be the start of a brand new webinar series in April. We're going to go back to trading earnings as earnings seasons kicks off. Likely that will jumpstart volatility a little bit. So very excited about doing that next month. Looking forward to seeing all of you there, and I hope you guys have a great afternoon.